Welcome back. The bull market starting off its third year strong. The S&P 500 trying for a record close today. Our next guest says history's on the side of the bulls in the months ahead. Let's bring in Carson Group Chief Market Strategist Ryan Dietrich. Welcome back.
Thank you for having me.
I feel like you're in the consensus, obviously now, among people who look at these markets and say economy good, consumers hanging in, and you're gonna put rate cuts on top of that. Maybe you have animal spirits and M&A. I don't know how the election is going to come out, but as long as there's some level of gridlock, market will be all right. What do you say to that?
No, you're right there. 18 months ago when we laid out the bullish case and no recession case, I think people thought we were crazy. They've come around a little bit, but I think it's really interesting here because I love the discussion you just had. You pointed out previous guests. This is a bull market, okay? Now we're in the third year of a bull market. My friend Sam Stovall said it like this. So once you get to 65 years old, the odds of getting 85 are really, really high. Bull markets work that way, Scott. Going back 50 years, there's 5 other bull markets that made it into their third year, like this one is right now. The worst any of them went was another 3 years, a 5-year total. The average was 8 years. So listen, I'm not saying we got another 6 years of a bull market. But what we're saying is it's an economy that keeps surprising the upside. The likelihood that this bull market is alive and well, still has a good amount of time left to it, that's kind of how we see things playing out here.
Are stocks, for where they are in this bull market, though, too expensive today, and then that's going to stunt their growth in the future, as some are suggesting?
Yeah, some parts of the market, I like that answer there, because again, I come with you all year saying small and mid caps are really cheap. Financials, industrials, kind of just right where you want them. They're not too expensive. Yes, large cap tech is still the pricey part. We're more neutral, that group. So maybe money sloshes around from that point of view. But even then, the mid to late 90s, of course, that's the period we all look at. Well, valuations are nowhere near what we saw back then. And the other thing about this is, when do markets usually peak? When there's over-the-top optimism. Look at the continued consumer confidence. Look at small business confidence. Even PE multiples. Yes, I know they're higher than we all prefer them to be probably, but they can go a good deal higher. So we're not ignoring that, but that's again why we're more overweight those cyclical areas, industrials, financials. Mid caps is actually our largest overweight. And then yes, we do have a slight overweight to small caps because those are parts of the market that are not extremely pricey.
I mean, industrials and financials, both of those sectors have been trading at record highs. Yeah. So they've already run a lot. What do you mean they are? They've been up a lot already. Why is there still value there then?
Well, because earnings are coming in strong, I think is the short answer there, right? What do we see with this earnings season so far? It's been strong, but you're right. We've been overweight those two groups like all year, but we're still there because the earnings are still strong. So earnings are justifying, we think in a lot of ways, the valuations that we're seeing on those particular areas. And I'm an old school John Murphy guy, right? Message of the market. I just know how those big 6 financial stocks reacted to earnings last Friday and Monday, right? Up almost 6% on average those 2 days. They said something the market clearly liked. And then we know, the underlying economy continues to be strong. I mean, retail sales yesterday, yes, but I love looking at the control group, way better than expected, one of the strongest numbers we've seen in a while. So the consumer is not going anywhere. Not perfect. There are cracks. We're aware of that, but still, that's a positive thing, we think, for those financials and industrials. Even if they're a tad pricey, there's still a good deal to go, and earnings are still strong there.
Why are you neutral on tech? Because I could hear you saying almost the same thing. Yeah, even though they're pricey, though, there's still a good long way to go because, there's earnings and those are going to be good, etc. You know where I'm getting at.
Oh, yeah. No, you're right. It was a tough interview. I like that question there. But listen, we've been bullish. I know you're right. You say we were right last year as we were bullish. We were more neutral tech because that didn't play out as well as we would have preferred. But again, we've still got a decent amount in tech. But we look at those PE multiples, and they are really, really pricey. You talk about AI. There's incredible things happening with AI. I'm not saying it's like another late 90s tech bubble here because there are actual earnings coming in. But when we look at those valuations, Scott, we just think tech is a tad pricey. And that can still be market weight. You can still have some winners in those groups. But again, when you have historic, let's look at small relative to large cap, okay? 99th percentile valuations right now for small cap relative to large. You look at large cap tech, it's even more. So it's just historically, those are some pricey areas, and we've said it for a while, and it's not like tech's doing terribly. I mean, tech's still doing pretty good, I'm aware. But we just think the other areas are going to do a tad better here.
All right, we'll leave it there, and we shall see. Ryan, thanks for the time. We'll see you soon. Good weekend to you. Ryan Dietrich. Up next, gold.